This computer. Hello and welcome to the first part of a three-part series of a roadmap from renter to home ownership. I am Bob from Smart Property Management with my partner here,
Debbie, nice to meet y'all.
and we have our property managers slash real estate agents on with us as well, Jeff Chatham, Ian Cornell, and Katie Larson. And today we are joined by Ben Binger at Ally Mortgage. And I'm telling you, this guy is an educator, he's a communicator. And we put this educational series together for you to have a roadmap on how to become a homeowner. So, with that, Ben, I send it over to you.
Fabulous. Well, hello. Thanks, Bob. We will go ahead and jump in here. Can you confirm we're seeing the slides?
We are.
Perfect. Seeing secrets to supercharging your credit score?
Yes.
Fabulous. That's what we're going to jump into. I'll put this next slide up here at the end as well. This is who I am. I run Alloy Mortgage. I'm a mortgage broker, been in the business for a little over 10 years, have helped hundreds of families with whatever their home mortgage solution might be. So the QR code there on the right, if you snap that on your phone, that'll take you to a digital contact card. You can save my information, phone number, text me, email me. If you're an Instagrammer, you can see there at the top. Feel free to follow me at Bernie Bing. And with that, we're going to jump into what is one of my absolute favoritist. Is that a word, Bob? Favoritist?
It is
One of
now.
my absolute favoritist topics to talk about, and that is credit scoring. There are almost 60 different ways that credit can be scored in the US, which is why it's so infuriating to try to figure out not only what your credit score is, but if you're seeing the right credit score. Just had a conversation with buyers this last week who I said, hey guys, your scores are in the really low 600s. We need to work on getting them up. And he goes, no, they're not. They're almost 700. And I was like, well, like, I appreciate that you think that, and thank you for educating me. But the reality is, the score that the bank's going to use was a 608.
Ben,
And so I said,
is
like,
there self scoring?
is there? Oh, absolutely, 100%. They're self-scoring. Now, will the bank take that? Not at all.
All right.
There's so many different ways that credit can be scored, and let me say this too. If you have questions, you can feel free to type them in the chat, or if you want to unmute yourself and throw out a question, you certainly can. This is kind of meant to be educational and conversational. But since credit scoring can take on a number of different scores, then we want to try to figure out how to identify not only the score that matters when it comes to qualifying for a home loan, which is your mortgage score or your FICO score, even that breaks into multiple scores, but also to know how you can improve your score. Whether you are tracking it on a free app like Credit Karma, or there's a lot of credit cards these days that will report it on a monthly statement or on your credit card app. Those often are similar to your mortgage credit score, but they might not be the score that the bank is using. So what I can say is we're not terribly interested in the exact score for this call. What we are interested in is helping teach you ways that you can improve whatever that score is. So when you're looking at a credit score, what this chart shows you is the different percentages of what factors into that, ultimately into that credit score. Why does this matter? Well, when it comes to whatever you purchase, the rate that you receive makes a difference based on the score you have. We're going to look at, just in this case, let's say a 550 home purchase. You're going to put 20% down, so it's a 440 loan amount. P&I just means principal and interest. So it's the repayment of the loan. The terms of repayment based on a credit score you see there are as follows. At a 620 plus credit score, your P&I, oh, look, we have Bob in the waiting room. Welcome back, Bob. Are you there still? I think he's still there.
I'm
Looks
still
like
there.
he's coming back. Are you there, Bob?
I've always been here.
That was weird. We just welcomed you back. You were in the waiting room.
All right.
Yeah, there's now Bob Varnum twice on here, so I'm not really sure who all's here, but we've got two Bobs.
The only
Welcome,
thing
Bob.
better than that is a third Bob Varnum.
So if you look at a 620 credit score, the principal and interest, so the repayment on the loan itself, for this scenario is 3383. Will jump all the way up to a 780 credit score. Well, at a 780 credit score, it's 2964. So you're looking at the difference of over $300 a month between a minimum credit score for qualifying and top tier credit score for qualifying. So those scores certainly make a difference. But when you're bringing less than 20% down, the advantages to better credit are compounded. If you look at monthly mortgage insurance, or PMI, it's the same thing based on credit score. Well, at 620, 5% down, you see right there, it's $521 a month. Well, if you jump up to a 780 credit score, 5% down, that goes from 521 a month all the way down to 139 a month. So not only do you have, if we go back, the P&I payment savings, but then you also have the mortgage insurance savings, and this can be as high as $500-600 a month in these scenarios that we're looking at here. Is somebody trying to chat? I heard somebody kind of cut out. Fantastic. We'll keep rolling. All right. So how do we identify secrets to supercharging your credit? Well, let's look at how your credit is scored. The number one factor is payment history. 35% of what your credit score is generated by is factoring in your payment history, which makes sense.
Ben,
Yes,
I'd like to just interrupt you for 1 second to highlight the resident benefit package that we give to all our tenants that reports to the credit bureaus your rent payments. So your
I love
benefit, your resident benefit package that not only gives you your air filters, it gives you your property insurance, your liability insurance,
Identity theft.
But this is another major component of that resident benefit package. We report your payment history. Actually, what's good about this, if you pay your rent late, they do not report that. So we only report the good stuff. So Ben, back to you.
I love that. What a great benefit for sure. On payment history, 35%. Making credit card and payments on time every month benefits your credit scores more than any other single factor. And just one payment made 30 days late can have significant damage to your scores. An account sent to collections or bankruptcy can have an even deeper, long-lasting consequence. So again, an absolute minimum. If you don't have auto pay minimum payments every month set up on every credit card you own, there's your first homework assignment, is make sure to set that up so there is never a chance that you're out of town or vacationing or so busy doing whatever you're doing that you forget to at least make that minimum monthly payment. I've seen scores drop as much as 50 points simply from somebody missing that minimum monthly payment. So 35% is payment history. My story about a Home Depot card, Labor Day several years back, my wife's dishwasher, boy, isn't that sexist, my wife's dishwasher. Our dishwasher, that I also load quite a bit myself, went out, and right around Labor Day, ran over to Home Depot, and sure enough, they had Labor Day sales going on, found the dishwasher we loved, get up to the counter, roll it up on the dolly, and they said, hey, would you like to open a credit card to save 10%? I said, absolutely, would love to do that. I'm doing the math of how much I'm saving. Get home, install that, have a very busy weekend, totally forget about that. And it was 3 months later. I don't know why I didn't check the mail. I don't know what was going on. And all of a sudden it hits me. Oh no, I just missed the first payment on this Save 10% Home Depot credit card. And now instead of saving 10%, I've just gotten a 30-day late ding on my credit. Probably took me 5-6 years before that actually fell off. So word of the wise is just be careful when you're opening new accounts to really make sure you're paying attention to those. The single greatest backstop to better credit scores is to pay your credit card on time, every time, even if it's just the minimum payment. So I said homework, make sure to set up auto pay minimum payment at an absolute minimum on every credit card you own. There you go. Number 2, the second greatest percentage of factoring in your score is credit utilization. This is the ratio of your outstanding balance versus your overall credit limit. If you pay your credit card off each month, even if you're paying it off in full, and you're looking at your score and going, I still feel like I'm kind of stuck with my scores. They're kind of on this shelf or this plateau. I can't get them to go any higher. Learning this section may be the secret that you need to help supercharge your credit score and grow it even more. Prime credit utilization ratio, that's a mouthful, is 30%. I'm going to show you what that means. To calculate that utilization ratio, take your credit limit, multiply it by 0.3, and then that number is the max that you ever want to have your credit card balance rise to. So the misnomer or the misinformation that's out there is, okay, if I have a $1,000 credit limit, I could run that up to $950. As long as I pay it off in full, it won't hurt me. The reality is it will. What creditors are looking for is only 30% utilization of your total credit limit on any given month. I'm pausing just to check and make sure there's nobody in the waiting room. Okay. Your credit card utilization rate is averaged across all of your cards. So we're going to show you an example here. For this particular buyer, we're going to call this buyer just randomly, we're going to pick Bob. We're going to call this buyer Bob. Bob, do you feel offended by that? Hopefully not. Credit card number one that Bob has, this is not smart management Bob, this is just our buddy Bob, is at a $6,500 credit limit and has a $1,600 balance. Credit card 2 is a $4,800 limit, has a $1,500 balance. Credit 3 is an $8,000 limit, has a $1,300 balance. And if you tally up all the credit limits, that tallies to $19,000 and change. The balance total of all of those is $4,400. And so even though credit card 2 you see is utilized at 31%, so a little over the overall target, once all three of those balances are averaged out compared to all three of the limits, the overall credit utilization in this example is 23%. Okay, so again, take your credit cards when you wrap up on this and figure out what are the limits. If you got, let's say, a $1,500 limit times 0.3 equals a $450 max balance that you ever want to carry on that card. Okay. If you have any questions on that, a lot of times people do. Feel free again to throw in the chat, and we can certainly look at that. Every card counts the same. So if you have cards that are higher, if you have multiple cards that are higher than that 30% limit, look for the card that will cost you the least to pay down to 30%, not the one that would cost you the most. And here's what I mean. If you have a $10,000 card with a $5,000 balance, well, you would need to get down to $3,000. So that would cost you $2,000 to get down to 30%. If you have a $1,000 card with a $500 balance, to get down to $300, which is the same 30% utilization, you need to pay $200. Here's what's crazy on this. Whether you pay the $2,000 to bring the $5,000 balance down to $3,000, or you pay the you pay $200 to bring the $500 balance down to $300, mixing up myself. Either way, either one of those cards at 30% is going to count the same towards your overall utilization. So pick the lower balances that are high and bring those down to 30% before you work on the bigger credit cards that have higher balances. Okay, also on this utilization topic, did you know paying off your full balance on time every month does not improve your utilization rate? Your credit card balances are reported from the credit card provider to the credit bureaus 7 to 10 days before they ever send you the bill. So if you want to improve your utilization rate, you could consider making half payments every 2 weeks. Meaning, if you've got a credit card that you max out or that you spend over that 30% each month, instead of just paying it off at the end of the month and having that, let's say 50% utilization or 60% utilization all recording to the bureaus, you could instead pay off half of that every 2 weeks. And now it's only ever going to show maybe a 20 or 25% balance at any given time. Caution on 12-month same as cash types of deals, in that most of the time what those creditors will do is set up an account for the entire balance. Meaning, let's go back to my dishwasher. If I'm going to buy, I don't know, an $800 stainless steel dishwasher and I ask for a new credit line at Home Depot to do that, they're likely going to give me an approval for $800. Well, they gave me an $800 approval. They put an $800 dishwasher on it. That credit card right out of the gates is now showing at 100% utilization. So again, you want to be careful. Ask questions on that if you're opening up a new credit card for a purchase. At a minimum, say, hey, I'm going to spend $800. Is there any way you can, open up this card for $2,000 or maybe a $3,000 limit? So your expenditure is not showing at 100% utilization from day one. Your supercharged secret for this one is to keep 3 to 4 credit cards open solely to be used as what I call low utilization credit support tools. Never use them as a break in case of glass emergency or we ran out of money this month. You got to be really careful with credit cards. I've seen so many folks that just spend on a credit card on money in their budget they just didn't have. Well, that's just not a good philosophy. The only entity that I'm aware of that can spend more money every month than what it has is the U.S. government, right? I have to look at my budget. Homeowners, renters, we all have to look at our budgets. If we don't have the money to spend, at some point you just run out of the credit to keep spending. But if you say, look, I run a good budget, I'm really trying to work on improving my credit, I pay my credit cards off each month, then the step, like I would say, is have a couple of credit cards that you don't need, you don't use, other than to put a single expense on any given month. To put a single expense. And here's what I mean. I have a, I want to say it's a Discover card that probably has something stupid like $15,000 credit limit on it. Every month I put my $6 Google Nest doorbell subscription on it. That's it. That's all that goes on that. And so that credit card shows a small percentage of a fraction of a percentage of utilization. And let's say that I did have a credit card that I maxed out at, let's say at 50%. Well, I've got that 50% utilization and that other card is barely showing 1%. So if I've got a 50% utilized card and almost a 0% utilized card, then my average across those two is 25% utilization. So if you think through those cards that I don't need to use, you don't want them to go dormant. You don't want to stop using them. You don't want to close them, and we'll hit on that here in a little bit. But what you do want is to make sure that there is a small revolving balance that can stay on there that can show you're still using it, but you're not maxing out the credit you'd have available to use them.
Ben,
all right.
Ben,
yes, sir.
Let me interrupt you again. So before I met you, and I thought the credit card companies, I still do. Actually, I think they're extortionists. They
are. Oh, yeah.
They'll steal your money. So I never used credit cards. If I didn't have the cash, I didn't have on my debit card, I didn't buy it. I actually had no credit cards, had no credit, had no debt, but my credit score was low because I didn't use my credit. That's incredible. I went to go buy a new iPhone and they're like, you need a credit card. I go, I have a debit card here with $10,000 on it. What? I need a credit card? And they're like, yep. So talk about that.
Yep. So, it's the whole concept of use it or lose it. I had surgery on an ankle back in March, and I learned very quickly that in order to rehab it, I have to keep using that ankle. It's not healing up just by me sitting up on an easy chair, not putting weight on it or anything like that. In the same way, that's credit. If you don't use it, it atrophies. If you don't use your credit card, even if you have it open, eventually a creditor is going to come back and go, hey, you know what? We don't see you using it. We're just going to go ahead and close this account up because it looks like you don't use it. Okay. So in the same way, if you don't have any credit, then how does a creditor know how to score you? And so unfortunately, if you don't use credit in a healthy way and you kind of just default it back to not using credit, yeah, believe it or not, that usually means your score. I've seen sometimes where folks have no credit. They don't even have a credit score that generates. I've seen sometimes where folks go, yeah, I haven't really had a need. Like I bought a car, had a car loan like 10 years ago, but otherwise I just live off of cash. Well, guess what? Then what the creditor sees is the last time you used credit was a decade ago, and now they're nervous. They don't know what your spending habits have been over the last 10 years. And Bob, to your point, they penalize you. They go, well, we're not really sure, so we're going to give you a really low score because you haven't been using it. So I know there's some big financial gurus out there that say, don't use credit cards, never use credit cards. Okay, well, if you want to solely and only figure out a way to live your life on debit cards and cash only, go for it. But the moment you want to buy an iPhone, or the moment you want to finance a car purchase, or you don't plan to buy a new home with 600,000 of cash, well, you're going to need to have a credit score. And if you're going to need a credit score, you might as well work on having the best score you can on that. Looking at the third factor that comes into play here, credit age. The longer your credit history, the higher your credit score will tend to be. The age of history is averaged across all of your accounts. So if you have a 10-year credit card and you open up 2 more new credit cards, you will have just cut your credit age from 10 years, averaged across those 3, down to 3 years. So this is where I say be cautious about closing up. All of us probably have, like that credit card I had when I was young, that credit card that, I was given when I was stupid. I shouldn't have gotten that card. Maybe it was the card they gave me when I was in college, or they gave me when I had my first summer job, or, and now it's just kind of sitting there. I don't know what to do about it. Don't close that account. Again, you're much better to put some small expense every month on there and keep showing it active. If you close your account, this removes it from your credit age. It removes it from your averaging of that credit age. So an example there, if you have 2 12-year-old kind of dormant credit cards that haven't really been used, and then you have 2 4-year credit cards, that equals an 8-year credit history average, or credit age average. If you were to cancel those 12-year-old credit cards because you're like, I don't really need them, your credit average just went from 8 years down to 4 years. Why does this matter? Because, get this, credit bureaus say the perfect score for your credit age is 35 years, which again is just one of these ludicrous things in how credit scoring works. But if you understand that, hey, you might as well figure out how to play the game the way they want you to get the highest scores you can possibly have. All right, the fourth out of these 5 categories is credit mix. It's the ability to successfully manage multiple debts and different credit types that would benefit your score. Credit scoring systems favor a mixture of installment debt, such as student loans, mortgages, car loans, layaway installment debt, personal loans, etc., and revolving accounts, or credit cards, home equity lines of credit, that type of thing. Now, don't go open a layaway account, or don't go buy a car, or don't go open up a personal loan just so you can create more diversity in your credit mix. Again, this only accounts for 10% of your overall score, but it's important to know that 10% exists. All right, the last one here before we wrap up is new credit. Accounts for 10% of your score factoring as well. It's a statistical fact that new debt raises the odds that you'll fall behind on your old debts. Credit scoring systems usually ding your score about 3 to 5 points for a credit inquiry. Good news is if you keep up with your bills, your score will typically rebound within a few months. Think of your credit score more like a growing plant instead of just like stamped permanent concrete. As long as your credit plant is overall healthy, if you pluck off a leaf here or pluck off a leaf there, forget to water it for a day, it's going to recover in time. The same is true when you get your credit pulled. I've had folks that come to me all the time that go, whoa, hold on. I need to get pre-approved for a home mortgage, but do you have to pull my credit? I'm like, that's literally why credit scores exist, is to figure out what you can qualify for with a mortgage. Be aware, even for a mortgage credit pull, your score will heal back in time. All credit pulls are not treated the same. Shopping for mortgages, car loans, and student loans are seen as positive credit behavior, and those are all lumped together within a 2 to 4 week period. Those pulls, let's say if you've ever been to a car dealership, bought a car, and then you check your credit and realize, oh my goodness, I've got like 5 different credit hits from auto loan providers. Well, they can do that because even if you had it pulled 5 times for 5 different auto loan checks, at the end of a month, all of those are going to roll into one single hit. It would only hit you at 3 to 5 points on your credit score. Be careful. Credit cards are not given the same treatment here. If you apply for 5 credit cards, you would see your score not only be pulled 5 times, but then dinged 5 times as well. Also, be careful for those Kohl's, Home Depot, Macy's, Best Buys. Would you like to save 10% deals? I know. These cards are often customized to only be used at that store, and they seldom help you build supercharged credit, so use them sparingly at most. That wraps it up, guys, for the secrets to supercharging your credit score. There's that slide I said put back up there. If you would like my contact information, if you have questions, you'd like to reach out with an email or a text or follow me on Instagram, any one of those things are lovely. And that concludes the first of our 3 parts on this webinar. Bob, I'll hand it back over to you.
Ben, I do have a couple questions. If you go back to the last slide, because I do have a question. So I was shopping for some clothes. Debbie's daughter was graduating from master's degree at UCLA, and at Banana Republic, I had a pretty substantial purchase, and they said, "Oh, you get 15% off if you open up this credit card." And I was like, yeah, why not? So you're saying that, all right, I got a $500 limit and I spent $500. That is going to affect my credit negatively.
Correct. So a couple of things to look at there. First, sorry, I can't swallow. It was like my swallower stopped swallowing. First, it is new credit. So the fact that you opened up new credit will ding you a little bit there. Number 2 is it's impacting your length of credit history. So you've got a new card that's starting with an age of 0. That's going to factor into whatever other cards you have. That could also contribute to driving down your score a little bit. Number 3, if they opened up that card, you set it a $500 limit, and if you ran it up to $500, then now your utilization ratio is being impacted as well. You now have a credit card that is at, looks like Bob's drawing on the, how did you do that? That was really cool. Oh, yeah. So, oh, sweet. Look at that. So your length of credit history is impacted. The fact that you open up a new credit card is impacted, and your credit utilization is negatively impacted as well. So it's hitting you 3 times.
Trifecta.
How it could ding your score.
All right. Another, so that's a trifecta. But another question for you. So I get mail at home, debt consolidations are us. Would it be best to consolidate high interest loans to this piece of mail that came in my house, to consolidate all that at a lower interest rate? How does that affect my credit?
Yeah, that's a great question. The biggest thing we're looking at there, I love this annotate, now I have to use it. The biggest thing we're looking at there is, look, if you've got, let's say, 4 credit cards that are all more or less maxed out, that's hurting you here with your utilization. So and then I would say this too, well, what if all of those cards are really pushing your ability to, I'm sorry, I mixed these up. Let's try this again. If your cards are causing you to be over that 30% utilization, then that's hurting you. If you have so many credit cards that are maxed out that now you're having a hard time making on-time payments, then that has the ability to hurt you twice. If that's the case, yeah, then rolling all of that debt into a debt consolidation loan will, at a minimum, bring down the overall payments that you're having to make, which will allow you to make sure that you're making on-time payments and not missing payments. As far as how it impacts, it might negatively impact your utilization. But if you have to pick between making your payments on time and lower utilization, again, making your payments on time is the biggest factoring there. So am I against a debt consolidation loan? No, I think it certainly makes sense. The biggest thing I would say from working with many, many homeowners is you have to be very careful that once you consolidate debt, you've got to change the habits that got you there. If all you're doing is consolidating that debt to free up a little bit of financial room, and then you're going out and you're getting in more debt, then eventually you're just creating the same negative nonstop cycle. So if you're going to consolidate your debt, great, consolidate it, and then look at those spending habits and say, okay, how can I reduce what I've been spending to make sure that once this debt consolidation is paid off, I'm back where I need to be on my credit utilization.
Awesome. Ben, thank you very much. Actually,
I got a quick question.
are there any questions? Yes, go ahead.
Well, yeah, I did the exact same Home Depot. Can you actually hear it? Can you turn?
Yep.
Yep.
We can hear you,
So we
Jeff.
have two
Yeah.
computers in the same room here. So
Oh,
can you guys hear me?
yes, sir.
Um, I did the exact same Home Depot thing not too long ago. I have
For
a
your
lot of
dishwasher, not your
outstanding cards,
wife's,
but
right?
the big. Can people hear me?
Yes, sir.
Yeah, you're muted, dude. Oh, I'm muted. Okay, so that's my bad.
Can you hear us?
That's what it is.
Caca!
Sorry, sorry.
Jeff,
Two
can you
computers
hear
in one
me?
room. We have all the volumes adjusted on these things. Um, and so that was a negative thing to do, was to open up that card. Now I used it for that one purchase, haven't really used it, and I got the letter in the mail the other day saying you haven't used it. We're not closing, but I had, I believe, good credit, and so I probably had a fairly high balance. But now they want to drop my balance pretty significantly because I haven't been utilizing it. Should I keep that balance up? Should I just close that card and let it go because it's new credit?
When did you open that card up? What year?
Oh, I probably did it last year or within the
Okay.
last 2 years. But I have a lot of credit cards that are probably 15 plus years old though
Yeah.
too. So
I mean, here's what I would say. It's these store cards where you only get detail or you only get discounts at that store that are challenging, right? Because it's like, well, I guess the next time I need to buy a refrigerator or replace a big appliance, I'm probably going to want to use it. But until then, I'm not. So, Jeff, in that situation, I would say there's a couple things to take into consideration. It's a new card, so it doesn't really weigh into your length of credit history. You can always go back and open up a new card and they're going to give you another deal for another 10% for 12 months, whatever. If you want to keep it open, it's as simple as just throw it in your wallet the next time you're out doing errands and just ring up the Snickers bar at Home Depot or, your box of screws, and now it'll show that it's being used and they'll probably get off your back. But
okay.
to your point, this happens with all credit cards. It goes back to that idea of I would compare it to muscle atrophy. If I'm not using muscles in my human body, they're going to shrink. They're not going to work like they're supposed to. In the same way, if I'm not using that credit card, the creditor is going to shrink it for you. They're going to say, "Oh, well, you don't need that amount of credit. We're taking it away from you." I've never really understood that because it's like, hey, if I've got a great credit score, why do you care what the credit limit is that I have on this card? But
Yep.
they will do that, and I've had accounts where they've done that as well. If you just leave it dormant too long, they might say, well, hey, you had a $20,000 limit. Now we're going to cut it to 17, or you had a $10,000 limit. We're going to cut it to 7,500. And they kind of just shrink it down because again, it comes back to if you're not using it, they're not really sure. And the longer it stays dormant, the longer they're like, well, we don't see any pattern here. So we want to take away the ability to overextend it. Versus if you throw something on it every 6 to 9 months, that should be enough where they're not likely to come back to you and take your limit away. If it was a 10-year-old card, I would say definitely keep it active. You opened it up a year or even 2 years ago. If you've got 15-year-old cards, focus on those. If they close the Home Depot card on you, you want to close it, not the end of the world. If they just take away your limit, not the end of the world either. Because when you go to apply for whatever the next big purchase is, you'd be able to say, "Hey, can you look at increasing my limit for this purchase?" And I've never seen, that if you have a good credit score, they're not going to deny you for increasing it again. Does that answer your
Okay.
question?
Yes, and one more,
Yeah,
because the husband and wife card scenarios, right?
like a
Um,
joint card.
Yeah, well, my wife has a card that she uses. I mean, I have the same card or the same account with my name on it. She
Yeah,
has cards with her name on it, but it's the same account, I believe. And she uses one. I don't use that card ever. is that affecting me, or is that only affecting her using that card with her name on it, or is because it's joint, it's affecting us both?
That's a great question too. If it's a joint account, meaning it's in both of your names, that means you jointly applied for it, and anybody's spending will jointly impact you both.
Okay.
So follow that logic on a mortgage, right? If you have two people that apply for the mortgage, and I see this happen unfortunately a lot in the case, let's say, of a divorce. Well, that couple applied for the mortgage jointly, and then all of a sudden there's a split, and maybe this spouse is supposed to be paying it and they're not, and this spouse is getting penalized. I've seldom ever
Yeah.
seen where a divorce improves someone's credit score because of situations like that. So
Okay.
there's a couple of interesting side notes on this, Jeff. With my, so if we go off the premise that anybody that's on that credit account is impacted positively or negatively by that account's utilization, okay, or the usage of the credit. So that can go both ways. Now, if your wife is overspending on that, or is running it up to the limit, or is doing things that you would prefer not to have tied to your name, it would be wise to probably cancel that card and have her just open up cards in her own name. Okay. But the
Okay.
flip side is true. If you say, look, she has healthy credit habits, then the good news is both of you are
Hers are better than mine.
yeah, yeah, and usually that's the case, because in the case of a married couple, you usually have one that carries most of the debt, right? They're the one that qualifies for a lot of the bigger debts, but there's enough joint accounts that the other one is on, that even though they don't qualify for all the debts, they've got enough accounts that their score's up higher than the one that's actually carrying all the debts. Okay. So I've seen that before. Here's
Mhm.
something that's interesting too, is if you have kids that you're trying to help them build their credit scores, um, you can set up to create an authorized user on an account, right? Now, depending on how much you trust them, whether you want to actually give them that credit card or not. But I've got a 13-year-old that has no idea he has a high 700s credit score because I added him as an authorized user, I think when he was 10 years old. And he doesn't have that credit card. He certainly doesn't use it. But I did this with every one of my kids when they were somewhere in their preteens. And my now 22-year-old came to me and goes, Dad, you won't believe this. I've got great credit. I'm like, well, actually, I will believe it, because I'm the reason why you have great credit. He's been on my credit accounts for almost a decade. And so when you got kids that are kind of launching into young adulthood, sometimes that's a great way to help them. Again, not necessarily to give them that card and get them in trouble, but to add them to your accounts. And as long as you're doing things we already talked about, paying those bills on time, keeping your balances at 30% or less, then your healthy spending will help them as well.
Great. Yeah. I
All
like
right,
that. I
Ben,
have
why
a
don't you come
13-year-old.
up? Jeff, are you done?
Yep.
All right. Any other questions out there? All right, Ben, I appreciate this. If you guys have listened to this entire thing, you know that Ben knows his stuff. There's his contact information. This is part one of a three-part series that Smart Property Management is offering up to their tenants, a roadmap for tenants to get to home ownership. So this was part one, supercharging your credit. We do have part two coming up July 23rd, busting home ownership myths. And then on August 13th, another Wednesday, part three, mastering the pre-approval process, which Ben can also help you out with. But did you know that your property manager is also a real estate agent and can help you find your forever home? Ben, appreciate this. I can't wait for the next one. Actually, I've already seen you present this to our group, but busting homeownership myths is another great one. But this is a great series to help anyone that wants to become a homeowner.
Absolutely. It's always a pleasure to teach these, Bob. I appreciate the opportunity.
All right. Thanks, everyone.
Thanks, Ben.
Thank you guys for this.
Thanks, Tina.
Absolutely.